For much of the last decade, revenue growth was treated as the clearest signal of business success. Companies were judged by how fast their top line expanded, how quickly they captured market share, and how aggressively they scaled. Cash flow mattered, but it often took a backseat to growth narratives. In 2026, that hierarchy has flipped. Across U.S. businesses, cash flow has become more important than revenue growth, and this shift reflects a deeper change in how risk, survival, and long-term strength are understood. Revenue growth looks impressive, but it does not guarantee stability. A company can grow sales rapidly and still struggle to pay bills, fund operations, or survive shocks. Cash flow, by contrast, determines whether a business can actually function day to day. After years of economic volatility, companies have learned that growth without cash flow creates fragile organizations that depend heavily on external funding and ideal conditions. One of the biggest reasons cash flow now matters more is the higher cost of capital. When borrowing was cheap, companies could afford to grow first and worry about cash later. Losses could be financed, working capital gaps could be covered. That environment no longer exists. Interest rates are higher, financing is more selective, and access to capital can tighten quickly. Businesses that generate strong cash flow internally are far less exposed to these shifts. Recent experience has reinforced this lesson. Companies with rapid revenue growth but weak cash flow were often forced into emergency fundraising, layoffs, or asset sales when conditions changed. Those with steady cash flow maintained control, continued operating smoothly, and even invested while competitors pulled back. That contrast reshaped priorities at the executive and board levels. Cash flow also provides flexibility. A business with healthy cash flow can make decisions deliberately rather than reactively. It can absorb short-term setbacks, invest in improvements, retain talent, and negotiate from strength. Revenue growth without cash flow often removes that flexibility. Every disruption becomes urgent, and long-term strategy gives way to short-term survival. Another reason cash flow has taken precedence is uncertainty around demand. Revenue growth today is less predictable than it once was. Consumer behavior shifts quickly, corporate spending is cautious, and forecasts change frequently. Cash flow smooths this volatility. Even if revenue fluctuates, consistent cash generation helps stabilize operations and planning. Investor expectations have shifted accordingly. Markets are paying closer attention to cash flow quality, not just headline growth. Investors want to know whether revenue translates into usable cash. Companies with strong cash flow are seen as more resilient and less risky, even if their growth is slower. Cash flow credibility has become a key driver of valuation and confidence. Operating costs have also become more complex and persistent. Compliance, cybersecurity, technology maintenance, AI investment, and regulatory requirements add ongoing expenses that cannot be avoided. Cash flow ensures these costs can be absorbed without constant restructuring or debt. Revenue growth alone does not guarantee that operating obligations can be met comfortably. Working capital dynamics play a major role in this shift. Rapid growth often requires upfront spending on inventory, staffing, marketing, and infrastructure. If cash inflows lag behind expenses, growth strains liquidity. Companies are now paying closer attention to payment terms, inventory cycles, and receivables management to ensure growth does not create cash shortages. This shift has changed how companies evaluate opportunities. Instead of asking how much revenue a project could generate, leaders ask when it generates cash and how reliable that cash is. Projects with slower but steadier cash returns are often favored over those with higher revenue potential but long payback periods. Timing matters more than scale. Subscription and recurring revenue models have gained appeal partly because they support predictable cash flow. Businesses value revenue streams that generate consistent inflows rather than one-time spikes. Predictable cash makes planning easier and reduces reliance on optimistic assumptions. Cost discipline ties directly into cash flow focus. Companies are scrutinizing expenses more carefully to ensure that spending aligns with cash generation. Permanent cost controls, Flexible cost structures and efficiency improvements all support stronger cash flow. Growth that requires excessive spending is increasingly viewed as risky. Hiring strategies reflect this change as well. Instead of staffing for projected growth, companies are aligning headcount with confirmed cash-generating activity. Productivity matters more than scale. This reduces the risk of payroll becoming a burden if revenue slows. Capital allocation decisions are now heavily influenced by cash flow considerations. Share buybacks, dividends, acquisitions, and expansion plans are evaluated based on their impact on liquidity. Businesses are more cautious about committing cash to long-term projects that do not contribute to near-term stability. Cash flow also strengthens negotiating power. Companies with strong liquidity can negotiate better terms with suppliers, lenders, and partners. They are less vulnerable to pressure during downturns and less likely to accept unfavorable deals simply to stay afloat. From a strategic perspective, cash flow supports optionality. It allows companies to wait for the right opportunities rather than chasing growth out of necessity. Businesses with weak cash flow often feel forced to pursue risky expansion or cost cuts simply to survive. Those with strong cash flow can choose their path. Importantly, this shift does not mean revenue growth is irrelevant. Growth still matters, but it must be supported by cash generation. Companies are redefining healthy growth as growth that strengthens cash flow rather than undermines it. Profitless growth is increasingly viewed as a warning sign, not a milestone. This change has influenced how success is measured internally. Leaders are evaluated on cash flow performance, not just revenue targets. Forecast accuracy, working capital management, and liquidity planning carry more weight in decision-making. Cash awareness has become a leadership skill, not just a finance function. The broader economic environment reinforces this focus. With uncertainty likely to persist, businesses want to ensure they can operate without depending on favorable conditions. Cash flow provides that independence. It reduces reliance on capital markets and increases resilience during shocks. In 2026, why cash flow is more important than revenue growth right now comes down to control. Cash flow gives businesses control over their decisions, timelines, and responses to uncertainty. Revenue growth without cash flow hands that control to lenders, investors, and market conditions. The companies best positioned today are not necessarily the fastest growing. They are the ones that generate reliable cash, manage liquidity carefully, and align growth with financial reality. Cash flow keeps the lights on, the options open, and the business moving forward when conditions are unpredictable. Revenue growth tells a story. Cash flow determines whether the story can continue. And in today's U.S. business environment, that difference has never mattered more.